Main Street stock, ticker symbol MAIN. On the 2nd of November, Main Street presented their quarterly report where they missed on EPS but beat on revenue. For the upcoming earnings, analysts think they will miss. On the 1-year chart, we see that the stock is up 18%, underperforming the S&P 500. And people love Main Street stock because of multiple reasons, one of them being the dividend. And I understand why, with dividend yield at 6.6% and of course the monthly payouts. So could this be the perfect moment to buy Main Street stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Main Street do? Main Street Capital Corporation is an investment firm engaged in providing customized debt and equity financing to lower middle market companies and debt capital to middle market companies. The investment portfolio of the company is typically made to support management buyouts, recapitalizations, growth financings and refinancings and acquisitions of companies that operate in diverse industry sectors. When we dive in the most recent earnings report, we see that Main Street reported a net investment income of $0.99 per share. The distributable net income is sitting at $1.04, with a net asset value of $28.33 per share, an increase of 2.3% year over year, which is nice. Operating expense to asset ratio is sitting at 1.3%, which looks good to me. And return on equity, one of the more important numbers here, is sitting at almost 18%, which is a great number. And as mentioned before, Main Street Capital is loved because of the dividend. And they declared a dividend of $0.7 for the fourth quarter. And on top of that, a supplemental dividend of $0.27. In total, this is a 30% increase year over year. And here we see the numbers one more time. And to me, everything looks really good. In here we see the dividends, DNII and net asset value per share. Over time, all three of them increase pretty consistent, even during the lockdown levels or the 2008 and 2009 financial crisis. On top of that, they have paid a $5.44 supplemental dividend since 2007. And those supplemental dividends can really add up over time. To me, it is very important that companies like Main Street are very well diversified. In here we see that the biggest industry is at 8%, so to me this looks really good. Another way of diversifying is based on transaction type and geolocation. LBO, MBO and recapitalization are both the biggest segments, representing 82%. The geolocation breakdown looks really good to me. In here we see the financial performance of Main Street. Total investment income and distributable net investment income. Both are growing quite similar, which is a good thing. But the growth ratios also look really good to me. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Main Street is a $3.6 billion market cap company. PE ratio is at 9, indicating they are undervalued. Later in this video I will show you my 3 price targets for Main Street stocks, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at $483 million, and in this graph we see that revenue went up in the long run. Of course we see the impact during COVID, and most recently revenue is really increasing at a high pace. Margins are going up and down in the past decade. During the lockdown periods, margins crashed. After that they recovered pretty quickly, but ever since 2022 margins are significantly lower. EPS is pretty much the same story as the revenue and the margins, nothing special to add here. Analysts expect that EPS will decrease from here in the coming 2 years, which feels a bit random to me. I don't see a clear reason why this would happen, to be honest. And for the revenue analysis, expect pretty much the same. And again, I don't see any signs of this actually happening anytime soon. Return on assets is sitting at minus 3%, which is not a good number. Return on equity looks really good, and the most important number, return on invested capital, is sitting at almost 11%, which is a great number, especially since it is higher versus the 5-year average. Current ratio is at 1.13, which is a decent number. And right now Main Street has 1.95 billion in total debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Main Street has 77 million in total cash, so they can't pay down a big part of their debt. To me, this could be a potential red flag. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is at a negative number. And to be honest, I don't like this at all. Shares outstanding are increasing in the long run, which is something that I don't like in general. But companies like Main Street issue new shares to raise capital, so I don't mind that much. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6.6%, which is a great number. Keep in mind that Main Street pays a monthly dividend instead of a quarterly dividend. Annual payouts at $2.88 and payout ratio is at 66%. I prefer 50% or lower, so right now they have 34% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 3.7%, which is a decent number. They have increased the dividends for 2 years in a row, which is very nice. And if you take a look at these numbers, the dividends paid since 2012, you see that Main Street did increase the dividends at a decent rate. However, during the lockdown periods they cut the dividend, which was a smart move, but ended the growth streak. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio used to be a bit high, but it is coming down, which is a good thing. In this graph we see the expected dividends in 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at the same rate as the past couple of years. Overall these dividends look really good to me, but how about the historical returns? I decided to compare Main Street stock with the overall market, in this case the S&P 500. On the 5-year chart we see that Main Street was beaten by the S&P 500 by quite a difference. In total, Main Street returned 76%, and keep in mind this is including dividends. The S&P 500 is sitting at 100%. On the 1-year chart things look pretty interesting. The S&P 500 is now underperforming Main Street by a small amount. In total, Main Street returned 29%, versus the S&P 500 sitting at 25%. On the 6-month chart, it is Main Street that is again the winner with more than twice the return versus the S&P 500. On the 1-month chart, it is again Main Street that is beating the S&P 500. So bottom line, Main Street is really getting some momentum lately, but on the 5-year chart, the S&P 500 was still the winner. So could this be the perfect time to buy Main Street stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 75, 77 and 79. For the free cash flow margin I'm putting in 30, 32 and 34. As I expect this number to recover in the future. For the PE ratio I'm putting in 10 and for the price to free cash flow I'm putting in 20. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety with this company this time. Right now Main Street stock is at almost $44. I hit analyze, and we see some interesting price targets. We have a low price target of $26 to $46. We have a mid price target of $32 to $54, and we have a high price target of $40 to $63. So these are all pretty big ranges. And to me, the mid price target is the most justified here. So that means they are right in the middle of this range. My final conclusion on Main Street is that I love the business. To me, it is a high risk, high reward investment in a way. I really love the monthly dividends they pay, and most fundamentals look good to me as well. There are some concerns about the debt and free cash flow, hence why the free cash flow price target is this low. On the other hand, the company is capable of growing at high numbers, and again, most fundamentals still look good. The valuation part is a bit tricky to me. When you have a big range like this, it is always hard to exactly pinpoint the price target. Right now they are in the middle of the mid price target, so depending on how you look, you might say they are undervalued. In my opinion, they are fair valued, and I would love to see lower prices. I don't think we will see low $30 anytime soon, but mid 30 to high 30 would be great. And I will slowly keep adding shares of Main Street throughout the year, and in the meantime collect the dividends and analyze them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor, and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up, and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching, and I will see you in my next video.